Hi everyone, welcome to Test Portfolio XSX. In today's video we're cranking up the volume on the tariff war. How did we rocket from 20.8% to 145%, then dial back to 50 to 60% in just 3 months? Attention! This video was created with assistance from artificial intelligence. Before we dive in, I'm not a financial advisor and everything that follows is for educational and entertainment purposes only. At the start of 2025, the weighted average U.S. tariff on Chinese imports already stood at 20.8%, a legacy of the 2018 to 2024 trade war. On February 4th, President Trump imposed a 10% minimum on any product that had previously been taxed at 0 to 9%. Inflationary impact? Minimal. Message sent? Every line item now carries the flag. Just over a month later on March 4th, the White House announced another 10 percentage point increase. The headline rate hit 20% and the effective average soared to around 30%. China retaliated, targeting U.S. agricultural exports. And by month end, the S&P 500 was down about 5%. The real shock came on April 9th. Trump's Liberation Day package added 125 percentage points in one go, pushing some lines to a theoretical 145% tariff. Supply chains trembled, the producer price index hit a 13-month high, and equity markets plunged intraday by about 3%. On April 11th, Trump quietly carved out an exemption list: smartphones, laptops, DRAM chips, OLED panels. None of these now face the 125% surcharge, only the base 10 to 20% remains. Excluded HS codes: 8517.12.00 for smartphones, 8471.30.01 for laptops, 8542.31 and 32 for CPU and DRAM, 8529.90.06 for LCD and OLED. Lobby pressure came from Apple, Intel, Nvidia, and the Consumer Technology Association. Market reaction: Nvidia up 4%, Apple up 3%, and the Nasdaq up 2.6% over 2 days. For example, a $999 iPhone would have cost $2,248 under the 125% tariff, but only $1,099 with the exemption. So leaks on April 23rd and 24th suggested that Washington would settle for a 50 to 60% uniform rate, if, and that's a big if, Beijing loosens its tech export controls. The offshore yuan instantly strengthened from 7.28 to 7.22 on that news. Do you think Beijing will actually give up its surplus? Let me know in the comments. Just a quick heads up, this content was partially generated with AI, and a reminder, this is not financial advice, so please do your own research. Monday, April 21st. Markets and politics collided in a single storm. Early Monday in Asia, the mood was, well, pretty somber. Investors were really anxious that the 145% ceiling tariff might actually stick, and they braced for more of those unpredictable Trump tweets. Safe haven flows into the yen pushed it up to a 4-month high after Tokyo officials warned that the chances for a yen deal with Washington were, honestly, pretty slim. Just before U.S. markets opened, Trump went after Fed Chair Powell on Truth Social, calling him Mr. Too Late and demanding immediate rate cuts. A White House aide even told Reuters that legal options for forcing out Powell were under review. The open was just ugly. The S&P 500 dropped 2.3%, the Nasdaq fell 2.5%, and the Dow was down 2.4%, while the 10-year yield spiked. A conference board report showed a 1.2% drop in forward-looking indicators, blaming high tariffs for choking new orders. Meanwhile, the IMF World Bank spring meetings kicked off in Washington, and honestly, the debate was all about the global growth impact of Trump's tariffs. At a parallel G24 session, emerging market ministers warned of rising funding risks. By the end of the day, Reuters was calling it the Trump-Powell panic, highlighting those dual worries about trade policy and Fed independence. Monday's storm really hammered home that the tariff war now threatens monetary policy stability as well. Tuesday, April 22nd. The sanctions whirlwind. The morning still showed a bit of Monday's hangover, but pretty soon, 3 new fronts broke wide open. India's steel defense. At midnight, New Delhi imposed a 12% 200-day protective tariff on 5 flat steel products. Tata, JSW, and SAIL had lobbied hard for this, as Chinese imports hit a 9-year high. Tata shares actually jumped 1.5%. U.S. solar probe. The Commerce Department's preliminary findings could lead to anti-dumping duties ranging from 70 to 3,521% on Cambodian, Thai, Malaysian, and Vietnamese crystalline silicon panels. According to The Guardian, Cambodia stands to lose the most. IMF red card. On day 2 of the spring meetings, IMF chief economist Pierre-Olivier Gourinchas cut 2025 global growth forecasts to 2.8%, warning that Trump's trade policy could trigger a negative financial shock. He also urged governments to protect central bank independence. New Iran sanctions. The U.S. Treasury blacklisted the LPG network of Reza Zarrab and several shipping firms, sending Brent up 1.8% to $67.44, and WTI up 2% to $64.32. Market roller coaster gold hit a record $3,500 per ounce. The dollar index slumped to a 3-year low, while the pound and yen rose to 7-month peaks. By the close, the S&P 500 was up 1.5% and the Nasdaq rose 1.8%, as Treasury Secretary Scott Bessent hinted at possible de-escalation with China. In short, April 22nd saw India, Washington and the IMF all lobbing fresh grenades at the trade war front. First there was panic, then an oil and equity rally on just a whiff of détente. Wednesday, April 23rd, the hope shock. Before the market opened, Reuters and the Wall Street Journal reported that White House sources were considering a 50 to 60% uniform tariff if Beijing eased chip export curbs. The offshore yuan jumped from 7.28 to 7.22, and the dollar index reversed course. At 10 a.m., Treasury Secretary Bessent declared, "The current tariff structure is unsustainable, but relief will only come through mutual steps." S&P futures jumped 1% instantly. Early in the afternoon, Trump emerged on the White House colonnade and said, "I haven't called Powell yet, but I could. Better coordination is needed," making it clear that no unilateral tariff cut is planned. Despite all the mixed messaging, markets just exploded higher. The S&P 500 closed up 3.3%, the Nasdaq jumped 4.2%, the VIX tumbled from 18 to 13, and gold dropped from $3,450 to $3,320 per ounce. Gulf markets rallied too, and Brent held near $87. April 23rd was a reminder that even a single leak about tariff cuts can ignite global risk-on sentiment, if only for a day. Thursday, April 24th brought what some called the two-faced relief. After riding a tariff rally the day before, markets woke up to a double-edged sword. Over at the Capitol, Bessent remarked, "A big deal with Beijing could emerge in weeks," and, well, S&P futures gained about 0.8%. 30 minutes later, weekly jobless claims rose just a bit, up to 244,000, an increase of 2,000. But the Labor Department warned, 145% tariff uncertainty is weighing on hiring. The dollar index slipped. Not long after, Reuters reported that Walmart and Target were canceling their summer container orders from China. TEU demand just plunged, and the freight ETF dropped 2.5%, while Pacific Basin shares in Hong Kong fell 4%. Meanwhile in Europe, things were looking pretty upbeat. The Stoxx 600 closed up 1.9%, and the DAX hit a 3-week high. A spontaneous comment from Trump, "Powell stays, now let's talk trade," seemed to reassure folks about the Fed's independence, at least for the moment. By the end of the day, the Dow was up 1.8%, S&P 500 gained 0.6%, transport stocks dropped 2.5%, oil held steady near $87, gold was flat at $3,320, and the VIX hovered around 13.5. On April 24th, investors were juggling both big deal optimism and some pretty stark supply chain realities. Ultimately, folks had to decide which story they believed, while logistics and labor markets continued to feel the longer shadow of tariffs. Friday, April 25th was what many called the calm before the storm. In a Time magazine interview, Trump said, "If a year from now we're still taking 20, 30 or 50% tariffs, that will be total victory." That really underscored that 50 to 60% is just his lower bound. Early that day, the CCP Politburo announced, "We will support companies and jobs hit by these tariffs," but they didn't offer any new big stimulus, just signaling their resolve. Later on, Chinese customs quietly exempted 20 U.S. medical devices from the 125% counter tariff. Small in dollar terms, but a symbolic diplomatic crack. Reuters reported that back in March, Apple airshipped 600 tons of iPhones, about $2 billion worth, from India to the U.S. via charter, doubling supply through Chennai to get ahead of possible 145% China tariffs. Meanwhile, 12 U.S. states led by Oregon, Illinois, and New York filed suit at the ITC, calling the tariffs unconstitutional and pointing to huge costs for agriculture and ports. California joined in on Friday. By the weekly close, the S&P 500 was up 3.7%, but the freight ETF dropped 3% as shippers cut China orders by 60%. So, to sum up, April 25th saw Trump's total victory rhetoric and Beijing's prep for worse stance dial up the political volume. Yet underneath all that noise, small carve-outs, the Apple Air Bridge and legal challenges showed that both sides were still looking for a path to the negotiating table. Saturday, April 26th brought rhetorical fireworks, even though the markets were closed. With trading on pause, the communications war just kept raging. In the White House Rose Garden, Trump doubled down on Friday's line. If a year from now we still have high tariffs, that will be total victory. And added, over 200 countries are waiting in line to make deals with us. Despite the headlines, S&P futures barely moved, which kind of suggests markets had already priced in all the tough talk. Later, at the Manila ADB annual meeting, Bessent urged Asia's Development Bank to wrap up BRI loans calmly, warning that tariff shocks could spiral into a crisis, though he called the China talks moderately optimistic. Then, at the IMF World Bank Spring Meeting's closing press conference, Kristalina Georgieva said, "The global financial system suffers under uncertainty. We need swift mutual tariff cuts." There was applause, but honestly, no formal commitment. With only limited trading, the offshore yuan held near 7.24, Brent futures drifted to $86.80 with no new Iran sanctions, and cryptos closed modestly higher as digital assets looked like safe havens during this ongoing US-China tariff saga. So the wrap-up for April 26th, the weekend's press volleys, from Trump's victory line to Bessent's ADB warnings and the IMF's cut tariffs call, kept diplomats busy, and markets will wake up Monday wondering if any of this rhetoric will actually lead to real tariff cuts. Okay, just a quick note here. These thoughts are my own and definitely not financial advice. Please do your own research. Honestly, this market feels like a roller coaster. One day tariffs leap to 145%, the next they drop to 50 or 60%. And then, you've got the Fed drama, warnings from the IMF, and all these strained supply chains just adding more fuel to the fire of uncertainty. At the end of the day, it's not really the final percentage that matters as much as the fact that nobody can price anything with real confidence. Lately, markets just keep replaying this tweet rally to panic sell to hope bounce loop, over and over again. I mean, a single leak can move prices by 3% globally. Crazy, right? So, what do I expect? Honestly, more wild swings in May and June. And if the Section 232 semiconductors probe actually adds 25% more tariffs, that could spark a fresh tech sell-off. For now, I'm holding off on adding any new positions until there's a bit more clarity. Quick question for you all. Where do you see the tariff rate in 6 months? 20%, 50%, or over 100%? Go ahead and vote in the comments. Thanks for listening. Remember, this is not advice, just my personal take, and do your own research. Status report for late April 2025. After this week's events, my portfolio remains unchanged. As I've shown in prior videos, I'm 100% in cash. Are you keeping a cash cushion, say over 30%, or have you returned to equities with less than 10%? Let me know in the comments. This portfolio is for illustration only, not investment advice. Thanks for watching. Hit like and subscribe if you found this helpful. Just so you know, this content was partially generated with AI. And remember, this is not financial advice. No liability is assumed for any errors.